Nike stock currently appears to be trading at its lowest valuation in 5 to 10 years, and hedge fund managers like Bill Ackman are taking notice. Bill Ackman just released his latest Form 13F, which reveals all the most recent moves in his portfolio, and one of the major moves he made is he increased his Nike position by over 435%, and this is now one of the larger positions in his portfolio at about 11.15%. Now keep in mind, he just recently added this to his portfolio, not in Q3 of 2024, but in Q2. We can see this was a new addition to his portfolio during that time, and at that time, he only bought around 3 million shares, which was around 2% of his portfolio, but in this most recent quarter, he added more than 13.2 million more shares to his portfolio. Now, Bill Ackman has been very successful as a hedge fund manager over the years. He's seen great gains from companies like Chipotle and Google, so it's definitely worth taking notice when he adds a company like Nike and when he starts adding even more. Now, if we look at the share price performance of Nike over the past year, down nearly 29%, and look at the past 5 years, down 17.61%. That is atrocious performance. Now we can see for a while there, it looks like the share price was doing pretty good, and it even peaked all the way up to around $170 to $175 per share, and it's dropped by over $100 per share, down to $76.66. But here's what's really interesting about this. If we jump over to the charting tab here on Seeking Alpha, what we're currently looking at is not the share price of Nike over the past 5 years, but the price to cash flow ratio. It's telling us how much are we willing to pay for each dollar of free cash flow that we're receiving as an investor. And as of right now, the company has a price to cash flow ratio of 14.46. So for every $14.46 that I invest into Nike, I'm getting $1 back in free cash flow. Now let's compare that to how the company has historically been valued by investors. For example, look at 2022. We can see Nike had a price to cash flow ratio ranging of anywhere from the high 30s all the way down to the high 20s, significantly higher than they're currently valued. Even if we look at the 2020 lows, we can see the price to cash flow ratio was sitting at around 21 to 22. So compared to how this company has historically been valued, Nike looks drastically undervalued, and the same is true even if we look at the past 10 years. If we jump over to my stock screener sheet and come up here and plug in NKE, Nike, if we come over here, we can see based on trailing 12-month free cash flow, the company has a starting free cash flow yield of 6.28%. And in this case, that means for every $100 you invest into the company, it's going to produce around $6.28 in free cash flow right now, and ideally, that free cash flow number will be growing over time. And then if we jump back over to Seeking Alpha and click on dividends, and look at the dividend yield for this company over the past 10 years, what we can see is the company now has its highest starting dividend yield in the past decade, and the reason behind this is because they've been growing their dividend while the share price has been going down significantly. All these are signs that the company could potentially be undervalued at current prices. So in this video, we're going to start digging into this even more. Why did Bill Ackman make this purchase? We're going to talk about the valuation. We're going to be looking at the recent earnings report and also looking at the news surrounding the company's recent dividend hike. But before we do that, I do want to quickly mention Seeking Alpha just started their Black Friday sale. Seeking Alpha is a tool I've been using for years now, and you've likely seen me use it in nearly all the videos that I make, and that's because I do use it on a daily basis. So I did just want to make you aware, if you are interested in Seeking Alpha, because of their Black Friday sale, you can currently get $90 off as well as a 7-day free trial. So now if we start moving forward and looking at Nike, like I said, recent news, Nike just increased their dividend payout by about 8.1%, bumping it up to around 40 cents per share. So if we jump over to my dividend breakdown sheet, let's go ahead and come up here and plug in NKE and hit enter. And all this data will load in. And like always, you can download any of my spreadsheets and get access to the Ticker Data add-on in Google Sheets by heading over to tickerdata.com. But like I already mentioned, the starting dividend yield is now the highest it's been in a decade. But one of the things we also have to understand is historically, this company's been a very solid dividend growth stock. They've increased dividends for, I believe, 22 consecutive years and have a 10-year dividend CAGR of close to 10%. So we're talking about a long history of growing dividends, as we can see right here, and growing them at a pretty healthy rate, nearly double digits in the past 5 years, being at about 8%, which is pretty close to being in line with that most recent dividend hike of 8.1% that we just saw. So for investors looking for reliable and growing dividends, Nike's been a pretty good pick for them historically speaking over the past couple of decades. And they've been able to grow that dividend payment without the payout ratio getting unhealthy. We can see a free cash flow payout ratio as of 2024 sitting at 32.78%, still leaving around 78 or 77% of their free cash flow left over to do things like reinvest back into the business, pay down debt, or even buy back shares. And speaking of dividends and buying back shares, if we go ahead and jump over to the recent quarter's earnings report, this was released in early October, but if we go ahead and scroll down, we can see Nike gives a little bit of space to talk about shareholder returns. And we can see in the most recent quarter, they paid out around $558 million in dividend payments, which is up around 6% from the prior year. Keep in mind, that's the total amount of dividends they paid out was up 6%. That's not on a per share basis. On a per share basis, it'll be even higher because the company is also buying back shares. We can see they actually allocate more capital to buying back shares than paying out dividends. Share repurchases was around 1.2 billion, reflecting 14.8 million shares retired as part of the company's 4-year 18 billion program approved by the board of directors in June 2022. So if we jump back over to my stock screener, we already plugged in Nike earlier, we can see the company has been steadily buying back shares over the past few years. For example, if we look at where they were in 2022, sitting at about 1.57 billion shares outstanding, and at the end of 2024, 1.51. So we kind of see a balance with this company between paying out dividends and buying back shares. And like I just alluded to, buying back shares actually allows them to increase the dividends on a per share basis at an even higher rate. So far we've talked about a lot of the good things about Nike. The company looks good from a historical dividend growth perspective. They look like they're trading at a good valuation, and we're starting to see confidence from hedge fund managers. So what's the reason for the huge sell-off? Well, let's start to dig into this earnings report just a little bit more. If we go ahead and scroll in, we can see first quarter revenues were 11.6 billion. This was down 10% on a reported basis compared to the prior year. That is a massive reduction in revenue. If we go ahead and jump back over to my stock screener, let's jump over and look at this on a quarterly basis. We'll come up here and plug in revenue, and we can see revenue for that most recent quarter right here came in at about 11.58 billion like we just saw, but that's significantly lower than we've seen in recent quarters. For example, their best quarter ever was in Q2 of 2024. They generated around 13.38 billion, so that's a pretty significant decrease. And if we look at Q1 of 2024, it was about 12.93 billion. Again, another pretty significant reduction. Now, if you've been keeping up with management and the statements they've been putting out, they talked about how a 10% reduction in revenue was actually expected, which is one of the big reasons we saw a sell-off in 2024. So this poor earnings report was actually expected. Now, if we keep coming down a little bit further, we can see on the bright side, gross margin increased by about 120 basis points, which is a good sign. But we can also see diluted earnings per share was 70 cents for the first quarter, down 26%. So again, a massive reduction in diluted earnings per share. Not a good sign, but this was also expected. In fact, analysts had already priced this in. If we jump over to that most recent earnings report, they actually saw a beat on the earnings expectations. They still saw a slight miss on revenue, but even with the huge decline in earnings, it beat analysts' expectations and pretty significantly as well. Now, if we look at expectations for the upcoming quarter's earnings, we can see they're going to announce it on December 20th post-market. And if we look at earnings per share revisions over the last 90 days, they have 0 bullish revisions and 20 bearish revisions, so analysts aren't expecting a good earnings report. Now let's touch on this gross margin increase that we just mentioned in the earnings report. If we jump back over to the stock screener and jump over to the profitability tab, I've already plugged in Nike, and we can see the gross profit ratio for the most part over the past decade has been fairly stable. The average is sitting at about 44.76, and last year it was about 44.56. So let's compare this most recent quarter to last year's gross profit ratio. Again, we can just use the ticker data function to easily bring this in. We'll select Nike, come over here and select gross profit ratio 2025 and Q1 and hit enter. And we can see a nice bump up, 45.36%. That's a slight increase from last year's gross profit ratio. So again, one of the minor but good signs from this recent earnings report. Now, if we start looking at what other banks had to say about this recent earnings report, for example, let's look at Jefferies. One of the biggest pullouts from the report was that Nike has not set a timetable for when it expects to see positive growth again. So management has said 2025 is going to be a really rough year for this company. In fact, if we jump back over to Seeking Alpha, look at the earnings expectations. If we come down here and click on earnings estimates and scroll down, we can see right here, analysts are expecting close to negative 29% year-over-year growth in 2025. And while they are expecting to start to see positive growth starting in 2026, the management team at Nike hasn't indicated that that will be the case yet. And the other difficult news right now is Nike has a lot of exposure to China. Nike's Greater China segment is roughly 15% of the company's total revenue. Now at its peak, it was about 22% in late 2021, but 33% of operating income. So China is a massive portion of the operating income of the revenue that Nike brings in. And the reality for Nike right now is the Chinese economy isn't exactly its best. And we also could potentially be on the brink of a tariff war. So there's plenty of difficulties for Nike right now, but there's some bright spots as well. But when it comes to valuation, we have to ask ourselves, is all of that downside already priced in? As a general principle, you don't want to buy a stock that already has its best case scenario priced in. You do want to buy a stock that already has its worst case scenario priced in. And it looks like that could potentially be the case for Nike, but let's dig into this a little bit more. Now, the first thing that I want to do is look at a reverse discounted cash flow analysis. And if you're not familiar with this, I know it looks complicated, but it's actually really not that complicated. All we're doing is seeing how is the market valuing Nike and how much free cash flow growth are they pricing into the company. So for example, if we look at 2024 free cash flow for Nike, it came in at about $6.6 billion. Assuming absolutely no free cash flow growth moving forward, 0% free cash flow growth, the company would be valued at about $57.99 per share. Now, the current price is $76.66. So what does this tell us? Well, the market is pricing in free cash flow growth, but how much? Well, we can play with this number to find out. If we plug in 1% free cash flow growth, it jumps up to about 62.35%. If we plug in 3% free cash flow growth, it jumps all the way up to $72.06. And then if we plug in 4% free cash flow growth, we can see we actually get slightly above the current trading price. So what this is telling us is right now, the market is pricing in slightly below 4% free cash flow growth for Nike moving forward. So the question you have to ask yourself is, do you think this is accurate? If you think Nike will produce higher growth rates of free cash flow over the next decade, then Nike's undervalued. And on the flip side, if you think free cash flow growth will be slower than this, then Nike is overvalued. When I look at this free cash flow number, yes, I understand the next year is going to be difficult for Nike, but 4% seems like a pretty low free cash flow growth rate to have priced into this stock. I think again, this is an argument that the company looks slightly undervalued at these prices. If we jump over to my stock valuation sheet and look at some other valuations, we'll plug in Nike. In Nike's case right now, we're not going to use a discounted cash flow because we just used a reverse DCF. But if we look at a multiples valuation, it's not going to be perfect, but it will give us a better idea of a couple of things. We can see here two comparables for Nike. Now we can't use Under Armour because they actually have negative earnings per share, which would mess up our valuation in this scenario. But we can see the average price to earnings multiple for these comparable companies sitting at about 22.77. Nike's earnings per share is sitting at 3.5, but we can see the average price to earnings multiple for these somewhat comparable companies sitting at 22.7. If we apply that same average PE to Nike, we'd come to an intrinsic value of about $80 per share. Now, I think the multiples valuation in the case of Nike is definitely not the best way to value the company, but it does kind of give us an idea of how these comparable companies are valued. I think most people would argue Nike typically trades at a premium, and we can see we actually get a pretty wide range with price to earnings multiple, but it's still interesting to see how they're valued in comparison to Nike. Now, the next valuation we'll look at, and the last one, is going to be our dividend discount model. We're valuing Nike based on how much they pay out in dividends and how much that dividend is increasing over time. And we can see in this scenario, I'm projecting a dividend growth rate of 6.75%, which shouldn't be too difficult for Nike to achieve over the next few years. If we look at those historical dividend growth rates, it's actually above that. The 10-year is at 10% and the 5-year at 8%, and that most recent dividend hike came in at about 8.1%. So I definitely think this is achievable for Nike. And when you apply a discount rate of 8.5%, we come to a dividend discount model price per share of $90.28, which is around 17 to 18% higher than the current share price for Nike. So yes, there's a lot going on with Nike. There's difficulties in China. Revenue is declining, and there is definitely a lot of negative sentiment around the stock right now. And it leads a lot of people to wonder, is the brand eroding? Is their competitive advantages eroding? Is the company losing their moat? But if we look at the stock screener for Nike, we can still see return on invested capital. This is usually a decent indicator of whether or not the company has a moat, whether or not it's a quality company. It's still been pretty good for Nike over the past few years. Actually, it's been really good. We can see in 2024, 21.57%. Typically, you want to see at least 10%. Now, 2020 was the exception. Obviously, that was a difficult year for a lot of retailers, and Nike was no exception. But for the most part, return on invested capital has been really good for this company. And the reality is, the brand is still very strong. Yes, they probably lost market share in some areas, especially when it comes to running shoe brands. But the reality is Nike is still probably viewed as the most favorable sportswear brand. Look at this. We can still see Nike. Most people know Nike and know them more than their competitors. More people like Nike than the competitors. More people own Nike than their competitors, and more people will purchase Nike again compared to their competitors. So there's still signs that this could be a premium company. Now again, like management has warned us, this could be a turnaround play that takes time. 2025 is going to be a difficult year for this company when it comes to their revenue, when it comes to their earnings. But there's undoubtedly people betting big on this company, with Bill Ackman being one of them. So go ahead and let me know what you think of Nike in the comments down below if you plan on buying or selling. Again, if you're interested in Seeking Alpha, now would be the time to check it out with the 7-day free trial and the huge discount because of Black Friday. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.